How do I become a homeowner? In this video, we'll cover what you can do to best prepare yourself for the mortgage process and what lenders care about when approving you for a loan. Becoming a homeowner is one of the most exciting life accomplishments. It helps you take control of how you build wealth and how you live. First, owning a home means that the payments you make each month go towards building equity in your home. Unlike rental payments that go to your landlord, the payments you make on your home's mortgage increase your stake in the value of the home and build long-term wealth. Second, owning a home helps you keep your monthly payments stable and avoid the hassles of rent increases and negotiations. Homeownership may also have tax advantages, such as the ability to deduct your mortgage interest and property tax payments from your federal income tax. And finally, owning a home can give you the chance to personalize your space and be part of a community. If you're like most people, you don't have the money to buy your home in cash. That's not a problem. A lender like SafeRate can help you get a mortgage so you can buy a home. So what is a mortgage? A mortgage is a loan that's backed by the property you're buying. Let's say there's a $300,000 house that you want to buy, and you only have $30,000. If you qualify, the lender can give you a loan for $270,000 to purchase the house. You'll make monthly payments on this loan until you have repaid the loan. Once the loan is repaid, you own the house free and clear. However, if you're not able to make the monthly payments for a sustained time period, the lender has the right to take possession of the home through a legal process known as foreclosure. Because the lender has this right, it's very important that your financial situation is stable, meaning that you're earning income, have manageable debt, and have sufficient savings for emergencies. So how do you know whether you're ready for a mortgage? There are 4 main factors that can help you determine whether you're ready for a mortgage. Do you have sufficient income to make continuous monthly payments over 15 or 30 years? Are your debt obligations, like credit cards, student, and auto loans, reasonable so they won't interfere with making your monthly mortgage payments? Do you have a good credit history and credit score? And do you have sufficient savings for a down payment and closing costs? So how do you know whether you have sufficient income and reasonable debt? Regardless of the type of loan you get, all lenders will evaluate 2 types of ratios, front-end ratio and back-end ratio, to determine whether your income and debt are reasonable to qualify for a loan. For the income in this example, we are referring to gross income. This is the amount of income you receive before considering taxes. The front-end ratio, also called the housing ratio, shows what percentage of your gross monthly income would go towards your housing expenses, including your monthly mortgage payment, homeowner's insurance, and property taxes, and homeowners association fees, if applicable. The back-end ratio, also called the debt-to-income ratio, shows how much of your gross monthly income would be needed to cover all monthly debt obligations. This includes the mortgage and other housing expenses that are included in the front-end ratio, plus credit cards, auto loans, student loans, and other debts. Living expenses such as utilities and groceries are not included in this ratio. So let's do an example to show how to calculate your front-end and back-end ratio. For example, let's say your annual salary is $72,000, meaning that your gross monthly income is $6,000. Your monthly housing expenses include $1,200 in monthly mortgage payments, $100 per month in homeowner's insurance, and $200 per month in property taxes. Your total housing expense would add up to $1,500, and your front-end ratio would be $1,500 divided by your gross monthly income of $6,000, which equals 25%. Now let's say, in addition to your total monthly housing expenses, you also have credit card payments of $500 per month, an auto loan of $300 per month, and student loan payments of $200 per month. Your total monthly debt would be $2,500, which is your housing expense of $1,500 plus the additional $1,000 per month. And your total back-end ratio would equal $2,500 divided by $6,000, which equals 41.6%. The maximum recommended front-end ratio is 31%, and the maximum recommended back-end ratio is 43%. Some loan programs may allow back-end ratios up to 50%, and compensating factors like a good credit score and savings can help if you're on the higher end of the maximum recommended ratios. You should always consult with your lender to evaluate all loan options before deciding on your course of action. In addition to having sufficient income and manageable debt, lenders also want to know that you have a history of repaying your loans before giving you a mortgage. This will be captured in your credit history and your credit score, which is a snapshot of your borrowing and repaying activities. The most common credit scoring system is called FICO and ranges between 300 and 850. Typically, a score over 580 is considered fair, while scores over 670 are considered good and scores over 740 are considered very good and exceptional. If you have a higher credit score, you're more likely to get a lower interest rate and better loan terms. Many lenders have a minimum FICO requirement of 620, but you may be able to get a loan with a 580 if you have a sufficient down payment or savings. You're legally allowed to access your credit report once a year free of charge from the 3 credit report agencies, TransUnion, Equifax, and Experian. Annualcreditreport.com is the official website where you can order your credit reports for free. And to learn more about how to build good credit, watch our video, What is a Credit Score and How Do I Build Good Credit? The last factor your lender will evaluate when qualifying you for your mortgage is your ability to pay for your down payment and closing costs. Down payment is the first large payment you'll make towards your home. In order to borrow money to purchase a home, your lender will want to know that you're bringing some of your own money to the table. This upfront payment is called a down payment. In 2021, the average down payment for a first-time home buyer was 6%. The amount of down payment you contribute will determine your interest rate and the types of loans you're eligible for. The higher your down payment, the lower your interest rate, and the better your loan terms. Loans with lower down payments have higher rates and may have upfront fees because lenders consider these loans as having more risk. Under certain circumstances, you can receive a loan with no down payment, but it's a good idea to save at least 5% for a down payment. To learn more about down payment requirements for different loan types, you can watch our video, What are my mortgage options to buy a home? In addition to a down payment, mortgage transactions require what are called closing costs. These are costs to complete the purchase transaction and include items like title insurance, appraisal, credit report, and other loan fees. Although closing costs are different in each state, a good rule of thumb is to set aside 2 to 5% of the loan amount for closing costs. Now let's do an example to calculate down payment and closing costs. Let's say the house you want to buy costs $300,000 and you're contributing 5% towards the down payment. That means your down payment is $15,000 and you will need a mortgage for $285,000 to buy the home. This is the home price of $300,000 minus your down payment of $15,000. And if your closing costs are approximately 3% of your mortgage amount, you would expect to pay $8,550 in closing costs. The total upfront cost of your home purchase in this example would then be $15,000 for the down payment, $8,550 for closing costs, for a total of $23,550. If you want to reduce this total upfront cost, you may be able to roll some or all of your closing costs into the loan amount, and it's a good idea to ask your lender about this option. Now that you've learned what it takes to be a homeowner, think about whether it's a good time to start the mortgage process. Is your front-end ratio below 31%? Is your back-end ratio below 43%? Do you have a good credit history, and is your credit score 620 or above? Although some lenders may accept a lower credit score. And have you saved enough to cover your down payment and closing costs?